Right, we're recording. Hi, thanks everybody for joining. I'm Michael Godsmark from Woodville Accountancy, and today we're talking all things pensions with David Robinson, who heads up our Woodville Financial Planning Department. How are you doing, David?
Good, thanks. How about yourself?
Yeah, very good, thanks. Very good. So just in case, I guess we will be mentioning coronavirus or lockdown at some point referencing. So it is the 29th of May, getting towards the end of it in England. I know it's different for different people in other countries in the UK, but yeah, I'm starting to see some relaxing. So we thought it'd be a good opportunity to start looking at sort of growth and well, we're always looking at ways to help our customers' businesses, and saving for the future or investing for the future is one of them. So yeah, thanks David for joining today. So yeah, I've got a few questions to run through. First one, what is a pension?
So basically a pension is a tax wrapper where money can be invested in a number of different investment funds, which can be matched to each individual's circumstances, and then the money will grow and it will be used to provide an income in retirement once that person decides he's no longer working.
Great. So you mentioned in a tax wrapper, what are the tax advantages of paying into one from an individual perspective?
So from an individual perspective, any contribution that you make into a personal pension, you will receive full tax relief at your highest rate. So if you're a high rate taxpayer, you'll receive 40% tax relief on any contributions that you make in. If you're a basic rate taxpayer, obviously 20%. So basically, every £80 you pay into a pension, that will be topped up to the tune of £20 by the government. Yeah. And also any growth that the money makes whilst it's in the pension is also tax-free.
Yeah, great. And how does it work if you're a higher rate taxpayer? Well, I guess I can answer that, but
So typically, if you're a high rate taxpayer, you'll get 20% tax relief at source through the pension, and then you claim it back. Yeah, and then you claim it back through self-assessment or etc. etc.
Yeah, and basically that's done by extending the basic rate band. So if you've been paying tax at 40%, then effectively, if you're PAYE only, you'll get some sort of refund on when you complete and submit your tax return. And how does it work from a company perspective? I guess I'm coming at this more from an owner managed business owner's perspective. Yeah, so someone like myself or a lot of our customers invest into their pensions through their company.
So any contribution that the company makes for any employee or director is tax deductible from the company. So it pays, the company will pay zero corporation tax on it. So you'll make that saving. And then the same again, once it's in that pension, any growth it makes again is fully tax-free, etc., etc.
Yeah, but there's no, but the contribution then doesn't qualify for a top up on the government side, does it? On the individual side?
Correct. Yeah, absolutely. Yeah, it's only on an individual that you'll get a top up from the government because you save that corporation tax from a business point of view.
Yeah, great. So we're making contributions to a pension. We're watching it hopefully grow. Maybe not the last 2 months, but definitely in the last few. Well, I've been watching mine the last week or so. Quite excited.
Yeah. It's starting to pick up now.
Yeah,
we've seen quite a bit of stability.
Yeah, I'm hopefully going to watch my pension grow next 10, 20, 30 years. When can we get it? When can we throw it all and buy a Porsche?
So you can access personal pension from the age of 55 or above, at which point you can have up to 25% of its total value as a tax-free lump sum. Mm-hmm. So if there's £100,000 sat in your pension pot, you can have up to £25,000 as a lump sum tax-free. And then depending on how you choose to take your benefits further, because there's a number of options, you can actually have access to the whole of the money, but the remaining money is taxable. So there's lots of things that we'd have to kind of run through there and work out what's the most tax efficient way of a client to do it. But the short answer is from 55 or above.
Yeah. And is that age increasing?
There is a plan for it to potentially increase. It's not signed off yet, but there is talk that it is going to become 10 years below your state retirement age. So if your state retirement age is 68, you won't be able to get it till you're 58.
Right. Okay. Do you know what sort of time frame that's going to be?
I heard last it was going to be around 2025, but I think that's being extended.
Right. Okay.
But there hasn't been much kind of talk about it of late, I think, because of everything else that the country's going through.
Yeah, great. So for people who've not got a pension, or people who want to know more about them, because sometimes I'll hear when I ask customers what they're doing for pensions, and they'll say they're with certain providers, I'm not going to name any names, and then they'll say, but it doesn't cost anything. Which is a bit of a, well, I won't say a lie, but it's it is a bit of a lie.
The thing is, every single pension provider levies a fee for having a pension open.
Yeah.
The problem is without an advisor kind of talking to you about your pensions, you'll receive the annual statement through the door, and it doesn't talk about what the charging structure is. All it says is this is your current value.
Yeah.
But typically, you would find something like a 1% charge from the pension provider, which is purely just a logistical charge for them actually housing that money and having that pension open.
And is that 1% of the fund value?
Yeah. So if there's £100,000 in there, you're paying £1,000 to that company each year.
Yeah.
And that's the bit that can differ from provider to provider. So when I'm researching and looking to see what a client should do around pensions, that's one thing that we'll do, because we're fully independent, so we can use whichever pension provider we want. That's one of the things that we will contrast and compare from provider to provider to make sure that a client's getting as low a cost as possible. Yeah.
So people are either looking to get a pension, or they're not sure how much the pension's costing. What sort of costs are there involved? Because you mentioned there's a pension cost. Are there fund costs as well?
Yeah. So obviously within your pension, once the money's gone into the pension, it's then invested into investment funds.
Yeah.
And again, the fund manager that is running that fund will levy a charge. And again, that can differ from each fund. It can be anywhere from, I'd say, typically 0.4%, 0.2 or 0.3% up to 1.3%, depending on which fund.
Wow. Yeah, so I guess you used the 100k example, which is a reasonable size pot, but if you've got a 500k pot, that 0.2 to 1.2, you really need to know what you're spending, don't you?
Very much so, yeah, because you can see over time that it would just erode a lot of the growth that you're making. It's a big percentage, all fees do is just erode that growth. So the lower you can get your fees to be, the more of the growth you're going to keep.
Yeah. And are all pension providers and funds created equally, or how does that sort of work?
So as in how they're run, you mean, or?
I guess I'm trying to ask a question when I sort of, I guess I'm just trying to break it down. I'm not that's quite the right question there. Do all pension funds see the same amount of growth?
No, absolutely not. No. Each fund, because it's invested in potentially different companies, different countries around the globe, different areas in different percentages, every single fund will grow at a different rate and a different level, because it is literally down to where the investments are held and how those companies perform.
Yeah, and how's that decided?
So the fund manager will do that.
Yeah.
So as a financial planner, I would decide which funds, which in turn decides which fund managers are looking after the money.
Yeah.
The actual which companies are held within that fund is done by the fund manager.
Yeah. And what sort of things do you do to come to a decision to invest for an individual?
So we would run an attitude to risk questionnaire with each client, which is kind of 14 questions, and we'll have lots of conversations around what level of risk they're comfortable with and if they've got anything. So any specific areas that they don't want the investment to go in. We have ethical funds available, for instance, and then using that and the conversation that I've had with the client, we would agree what level of risk they're comfortable with.
Yeah.
I would then go and choose which funds are available within those parameters and choose it from there.
Yeah, great.
And that's also something that can be changed over time.
Yeah.
So we can change the level of risk at any point. And typically when I'm doing my annual reviews with clients, that's something that we'll pick up each time and see if that's changed. If their attitude to risk has changed, then we change their portfolios at that point.
Yeah, and I guess a typical example of that could be as you're maybe coming closer to retirement age or your expected retirement age, you might want to move. You might want to change your allocated percentages between your riskier and your less risky asset classes, so that you're minimising the risk of losing a chunk of money like you could have done in the last couple of months.
Absolutely, yeah. I typically, you're better off to go kind of chasing the growth earlier on, so to have a higher exposure to riskier funds or at the equity markets earlier on in your pension planning. And typically I'll be having the conversation with my clients usually around 3 years before they're approaching their retirement age, that then is a good time to start de-risking their portfolios and kind of put your arms around the money that they've just spent 20 years building up. And as you said, to keep it much safer if something like this should happen.
Yeah. And in your opinion, do you think everyone should have a pension?
I would say yes, unless they can live off the state pension in retirement, which in the last 10 years, I've not had anyone tell me they think they can do. So I think everyone should. Obviously, the government brought out a number of years ago the auto-enrollment, which is encouraging most people to have an individual pension. But yeah, in my opinion, yes. But it's got to be affordable for that particular client, et cetera, et cetera.
Yeah. So when's the best time to start saving into one?
It sounds a bit cliche, but the earlier the better. Because if I'm sat with a client and they've got a goal income in mind, the sooner they can start putting money away to that goal, the less money they'll have to contribute on a monthly basis.
Yeah, because of the compound effect.
Correct, yeah. If you was to invest £20 a month for 30 years versus £100 a month for 15 years, you're going to see the same result probably, or certainly something pretty similar.
Yeah. Well, recently, one of a new customer we picked up that we sent to you back in January this year, he's exactly 10 years younger than me, and we looked at £100 a month for me for 30 years to get me to 65, him for 40 years to get him to 65. And I think we did estimate a 7% growth rate increase, something like that. And he would pay in £14,000 more, but end up with but his valuation would be 120k more. It was something like that.
It's such a big difference.
Yeah, just those extra few years.
Yeah, absolutely.
So obviously there I've used 25 and 35. If you're 45 or 50, I'm thinking, 40 years is a while to wait, potentially. Is it ever too late to start paying into one?
No, absolutely not, no. I actually had a client come to me a few weeks ago who was actually retiring. And believe it or not, we opened him a new pension because he had built up savings elsewhere. Mm-hmm. So he had £30,000 sat in an ISA, which we opened up a pension, put into the pension, which obviously he got the full 20. He got his full tax relief on the full £30,000 from day one.
Yeah, and
literally drew it out the week after. So he's literally never too late.
Is there any restrictions on doing that? Because that sounds like.
Well, so you can only pay in. You can only pay into a pension up to your full salary for that year. Yeah. So if you've only earned 20,000, you would have only been able to pay in 20,000.
Yeah.
Or up to a maximum of 40,000 per year.
Yeah.
You can use what's known as carry forward if you earn £100,000 a year and you've got previous years unused allowance. You can go back 3 years.
Yeah.
but you've got to have you've got to have earned the money in that year.
Yeah, great. So if you've not got a pension set up and whoever's watching this wants to set one up, what do they need to do?
Best thing to do is to get in contact. I'm sure Michael will share my contact details after this. And it's literally a 5-10 minute phone call, which is where we can run through, and I'll know within that time if we can help, what we need to do, and then we'll kind of set a what's next from there.
Yeah, which at the moment is probably a video call.
Yeah, absolutely, yeah.
And can you tell me tell everyone what a SAS is?
So a SAS is a small self-administered pension scheme. Companies, smaller companies tend to use them. So it's almost like having your own company pension scheme. You can have up to 12 members in there, but then all of the members' monies are pooled into one pot. Again, I set one up a couple of months ago for a client, and they're looking to purchase new commercial premises for their company using the SAS.
Great. And then they can use their pot to buy that, and then the rent gets paid across from the company into the SAS.
Correct.
That's then tax free.
Yep.
Great. But
absolutely.
then they receive a tax deduction in the company.
Absolutely, yeah. It's so tax efficient for a business owner because it doesn't have to be used as a SAS. You can use a SIP, so an individual. It doesn't have to be a group scheme. But so tax efficient for any business owner to buy or purchase his or her commercial premises that they work out of. As you said, send the rent from the company to their pension provider, and we have a lot of clients that do that.
Yeah, great. Cool. So I've got a few questions that have come in from Tom. I'm 50 and worried about the recent drop my pension's just had. Should I stop my contributions?
I wouldn't stop contributions at the moment. In fact, if anything, if affordable, it would be a good time to increase contributions. Because, as Tom rightly said, there's been a drop in the stock market, which has meant that values within pensions have took a dip. But what that means is each time clients are paying in on a monthly basis at the moment, they're kind of getting more bang for the buck at the moment because they're buying the fund that they're invested in at a cheaper price because markets are low.
Yeah.
And then when markets
recover, more units.
Correct. Yeah, absolutely. Yeah. And then as and when markets recover, what you'll see is the pension will boost in value because they've been buying those units, as you rightly said, now while they're cheap. And then as the unit price increases, that's when they'll see a big increase in their values.
Yeah. Great. Alex, I'm 24, just starting in business and want to start saving into a pension. What's the minimum amount I can pay in? And should I wait until I can contribute more?
So minimum amount that you can pay in varies from provider to provider. But the providers that we use, it's literally £10 a month that can be paid in as a minimum. So there isn't really a minimum.
No.
And in answer to the should she wait until she can pay more, no. And the reason for that is, as we were saying earlier, about when you've done the work with yourself and that other client, the sooner she starts paying in or anybody starts paying in, the better. One, because you get that compound growth effect. But two, the business or the person will soon just see that as another direct debit and away you go, and can then increase it in time as and when cash flow or affordability allows it.
Yeah. And I think it just gets you into the habit of saving as well, doesn't it? And I think it's good to save into something that you can't. So what would happen if Alex, who's 24, decided in 5 years she'd saved up £15,000, she needed that money? Could she get access to that money, and what are the implications?
So she wouldn't be able to get access to the money within her pension because she can't access it until she's 55.
Yeah.
Unless there is a terminal illness clause within pensions, but obviously let's hope that that's never the case.
Yeah.
So which is why when I'm working with businesses or individuals, I will always use a pension that is flexible on being able to pay money in. So set the direct debit at an amount that they know they will never kind of need to access that money, etc., etc. but then have the ability on an ad hoc basis to pay in lump sum monies.
Yeah.
And as you know, we do it quite a bit when people get to their tax year end.
Yeah.
So they'll come and speak to you. You'll tell them how much they can pay into a pension. They'll ring me and say, Dave, I need to pay this in. We send them an email with some bank details, and they make that payment.
Yeah, and it's so tax efficient, isn't it? Like say, we've had a few recently where people have been able to put in or top themselves up to the full 40k. I think we had one recently 80k, wasn't it? Because we used
absolutely, yeah.
Like in that example, obviously you've got to have the cash flow for that, but
yeah,
they've saved what 16k in corporation tax. It's
absolutely, and that particular client made it. Yeah. Absolutely, and perfect timing from that particular client, because right at the beginning of this pandemic, when markets were at probably the lowest point.
Yeah, they weren't
already seeing growth.
Yeah, 100%.
So yeah.
Yeah. Oh, I've just got another question in now from Michelle. Is my pension safe?
Yes. So a very common question I get, because I'm sure people have seen in the press horror stories around pensions, etc.
It's not even in the press. You hear it off your parent. Well, I hear it off my parents and family members.
Yeah, absolutely.
They get down the pub. Don't pay into your pension. Stuff it under the bed.
Absolutely. And that is typically born out of older pension schemes that were a little bit different. Most people will know them as final salary schemes, and they're run very differently. And they were up for abuse. But personal pensions these days are very different. Each individual person who has a pension has their own individual policy number, and their money is ring-fenced for them. And from a financial stability point of view, from the pension provider themselves, it's not the pension provider that holds the client's money. It's the investment fund. And within that investment fund, the monies are actually directly sat within the companies that are chosen. Yeah. So for instance, our model portfolios that we use for our clients, the money is spread across 14,000 different companies in 44 different countries. So it's so well diversified that there's no way that you could wake up one morning, have £100,000 and the next morning have zero. It will fluctuate in value with what goes on, but it can't just disappear.
No. Yeah, and I always use the example where one of my friends, that if that happened, you've got bigger problems.
Absolutely, yeah. It literally, the world would have to implode for someone's value to be zero. It would mean that 14,000 companies in all different areas, so some in retail, some in banking, some in technology, some in whatever it may be, for them to all go bust overnight or bankrupt. It just couldn't happen.
No. Well, not in the world we know it anyway. And
no, absolutely not.
And like the companies and the provider that you go through, are big companies, aren't they? Like you've probably not heard of them. You could well have not heard of them.
Absolutely. So we use a pension provider quite regularly called Parmenium, which is the one where no one's really ever heard of them. But that's because you can only access them via an advisor. But they're actually owned by Standard Life and Aberdeen Asset Management. So, extremely large global businesses. So the financial stability is absolutely there. But because you can only access it through an advisor, they don't advertise, they don't put the name out there. No. But what that means is the costs that we were talking about right at the beginning are nice and low, because they don't have to pay for advertising and all of these things.
Yeah, so when you hear about institutional investors, it's these companies, isn't it?
Absolutely.
They have the clobber.
Yeah, right. Very much so.
Yeah, I've got another question from Daniel. I have 3 pensions from previous employers, 3 separate employers, which are all frozen. Can anything be done with them?
Yeah, absolutely. We do this process for clients on a weekly basis. So what we can do is we'll basically write off to each individual pension provider, gather all the information that I need. It's about 8 questions that I ask them, kind of around, what's the charging structure and where's the money invested, how's it been performing, etc. I'll then use that to analyse whether it is in...
David, sorry. Did I freeze then?
You did, yes.
So did you. So I don't know which side it is. So let's do the question. Oh, my internet connection is unstable. That is amazing. Just what I need. On a cloud recording of a webinar. It's like the closed OneDrive. He's probably. I can just hear my baby boy moaning. So no doubt, my 3-year-old has demanded the TV to go on, and he's probably watching BBC iPlayer. Right. Okay. So Daniel got 3 employers from 3 pensions from 3 previous employers, which are frozen. Can anything be done with them?
We do this process week in, week out for clients. What we'll do is we'll write off to each individual pension provider, ask them numerous questions around, what's the charging structure and where's the money invested, how's it been performing, and then I'll do some analysis around all 3 pensions, and it could be that my advice is, do you know what, all 3 are absolutely fine, leave them all where they are, or all 3 would benefit from a move and we can consolidate them all into one new pension, get the money back invested into a risk appropriate fund, or one may have a particular good benefit that we say leave and move to. But we'll come back with a bespoke recommendation for each client as to what they can do.
Great. And on that recommendation, is there any fee for your recommendation at that point?
So there's no fee for us to do the initial work, the initial analysis, and come back with the recommendation. If a client decides not to go with our recommendation, there's 0 fee. If a client does wish to go for our recommendation, I will say, I recommend you do this for these reasons. If you want me to do that work, it will cost you this, and they either say yes or no. If they say yes, the fee, and there's different ways they can pay that fee, which can either be direct, which some business owners pay out of the business, or they can opt for it to be taken out of the fund that we're moving over and things like this.
All right, okay, great. Sam's asked, can I buy property with my pension? We cleared that up on the commercial side when you can. Hopefully you're listening then, Sam. What about a residential property?
No, you're not allowed to hold residential properties, so buy-to-lets, things like that. Unfortunately, you can't hold within the pension. It's got
you used to be able to, though, didn't you?
There was and then they pulled the rug at the kind of last minute, and there was a lot of upset people who I think had planned to buy all these apartments in Manchester and Leeds, etc. And literally at the last minute, it was pulled, and it is only commercial premises.
Yeah, great. I can't see any more questions now. If anyone's got any more questions, just pop them in the box. Is there anything else you want to add, David?
I don't think so, no. Just obviously, if anyone has got any further questions, wants anything from me, just drop me a line, give me a ring, and we'll answer as many as we can. Great stuff. So I think we should wrap up just in case my internet crashes, which I think is just about to. Yeah, great. Well, thanks everyone for joining. And David, I'll speak to you soon. Speak to you soon. Thanks a lot. Good, mate. Bye-bye. Cheers. Bye-bye. Bye.